morning's webinar. This is part of our advanced planning webinar series, and today's topic is business continuation planning strategies, and this is going to be presented primarily by David Stork, although I am here as well, life insurance sales manager, sales director here at Financial Brokerage. We also have David Corwin on the line with us, annuity sales director here at Financial Brokerage. And let me give you a little introduction about our main presenter here, David Stork. He is not only our executive vice president, but Dave is our advanced case design specialist. And Dave has been involved in life insurance sales for 38 years in many roles as a career agent and sales manager for a large mutual company, as a life sales consultant to property casualty and health insurance agencies, as well as financial planners for two large multi-line companies. And for the past 10 years, Dave has served as our executive vice president here at Financial Brokerage. Dave continues to work nationally with a group of agents as a life insurance and advanced planning consultant, and assists in developing personal, small business, and estate planning sales. His experience in all of these areas can help you sell life insurance cases with large premiums. And one little housekeeping item I almost forgot to mention here, all of your lines are muted right now to cut down on background noise. I think I did mention you can type questions in the bottom of the control panel of your screen there, and we may open the session up for questions. I have the ability to unmute your lines as needed throughout the webinar, and certainly at the end if nothing else. So at this point in time, I think we'll turn it over to you, Dave, and we'll let you get started.
Sounds great. Thanks, Brian. I'd like to welcome everyone to our first in a series of advanced planning webinars. As a career life agent, I started selling small family plans with premiums ranging from about $15 to $30 a month. As a result, I have an appreciation for sales of all sizes, and know that even the smallest sales are important to the client and the agent that makes them. Having said that, our purpose in sharing these advanced sales concepts is to increase the size of the average sale. While time won't permit to discuss huge detail of each sales process, we will point out the needs and opportunities you'll encounter with your current and prospective clients. We intend to provide a concise and open forum to introduce concepts, allow you to ask questions, and discuss specific cases as time permits. If more time is required, we'll be happy to arrange one discussion with each of you on your personal cases. As Brian mentioned, our first presentation is on buy-sell planning with life insurance, and it's one of the most common sales options you will face with small. As the next slide points out.
Yeah, we're all muted.
The next slide, Brian. Hello, Brian. Yeah, thank you. It's shared by, the business succession planning is shared by the majority of small private businesses. As the known authority of corporate boardroom practices, the National Association of Corporate Directors completed research and found that less than 25% of private companies have a formal succession plan. Further studies show that only 30% of family businesses reach the second generation, and only about 1 in 10 make it to the third. While these numbers may seem hard to believe, my personal experience when discussing succession planning with a business owner is they likely understand the need, but often feel they're too busy running their business to take the time to complete a formal plan. They may have a general idea of what they'd like to happen if one of the owners dies, but may have gone, and maybe even has gone as far as to talk to their attorney, but even then haven't taken the time to complete the process. And an untimely death of an owner, the company oftentimes will not have enough money for a smooth transition, including how to continue in business with or how to buy out the deceased heirs. They won't have a replacement readily available to resume the duties of the deceased. And if they're forced to liquidate the company because they can't agree upon a transition or a buyout, a forced sale will commonly yield less than 50% of the perceived value. A good way to light a fire under your business owner is to ask, how would you like to be in business with your partner, spouse, or family member if your partner dies? As the next slide shows, there are four main concerns that a surviving owner and heirs will face. How are we going to operate the business without the deceased? If the heirs want the company to buy them out, where will the money come from? If the business represents the majority of the deceased estate, where will the money come from to pay taxes due and any final expenses? And finally, what is the business worth? Surviving owners have the following options. They can go into business with the heirs. They can allow the heirs to sell to outsiders. They can sell their own shares to the heirs, or they can buy out the heirs. The next slide will show that the surviving owners' first three options are rarely acceptable. The best option is usually to buy out the heirs' interest. However, will they come to an agreed upon price? And what is the method of payment, lump sum or installment? And of course, where will the money come from to complete the sale? As the next slide shows, in most situations, a properly drafted and funded buy-sell agreement is the best solution. Under the agreement, the heirs agree to sell their interest to the surviving partners or the stockholders. Life insurance will help fund the buyout, and the agreement includes a formula for determining a fair market value, or they can use a formal appraisal to determine the fair sales price. Since the value of the business will change over time, the stated price is rarely used as a agreed upon value. Our next slide reviews the most common prospects. Your common prospects will include closely held businesses that are organized either as a C or an S corporation, a limited liability company or partnership, or a sole proprietorship. Usually the prospect is the existing owner themselves, but it may also include a non-owner key employee who has an interest in buying out an owner's interest at death. It can also be a child or other family member who has a working relationship with the surviving owners. The company's CPA and attorney may also be a good referral source for a qualified and interested prospect. The next slide shows products offered at financial brokerage and include the most common types of life insurance used to fund a buy-sell agreement. They include level term insurance, return of premium term, universal life, and whole life. Term insurance offers maximum coverage, of course, at the lowest annual outlay, and is the most common choice for small businesses, especially those that are newer in the business. It's easy to understand and can be tailored to each owner's projected retirement age or beyond. Return of premium term can provide the same benefits as term insurance, but also provide guaranteed funds at a specific date to help fund a buyout at retirement. Universal life provides permanent protection with flexible premiums and the option to build a sinking fund for a retirement buyout. Whole life provides permanent protection with the added guarantees of a sinking fund either for a buyout or emergency fund as needed by the business. Continuing on the next slide, you will see that types of life insurance used can be tailored to the owner's ages, the company's ability to pay, and can also be impacted by the need for additional coverage for key person insurance. There are circumstances when an owner dies and the bank loan may become payable in full, or there might be other obligations they need to fulfill. The next slide points out that once a client decides to proceed with a formal plan, they also need to provide an estimated value so that we can apply for the appropriate coverage amount. Most carriers will allow evaluation and insurance coverage based upon a formal appraisal, but this isn't a common choice because of the expense. In absence of a formal appraisal, an estimated value based on book value, a discounted future earnings, excess earnings, or a capitalization of earnings can be used. The financial statements provided by the company's CPA will often be requested by the carrier and used as an appropriate valuation for these formulas. It is very possible, however, that the accountant has already provided an estimated value using the most appropriate method for the business. As the next slide shows, key questions you can ask your clients are what value do you believe the business to be worth? And what would you sell it for? Have you had a formal business valuation? Do you have access to your financial statements? Are there any obligations or debts due at death of an owner other than that might be a bank loan or other obligation? And finally, what is your business structure? Are you a C Corp, an S Corp, LLC, or sole proprietorship? Going to the next slide, you'll see there are four main types of buy-sell agreements: the redemption plan, the cross-purchase plan, the wait-and-see plan, which is a combination really of the first two, and a one-way purchase plan. And this is ideal for non-owner purchasers, which would include a key employee. The agreement used will be based on the type of business organization, and the company's attorney oftentimes determines the best design. The next slide shows the pros and cons of a redemption plan. A redemption plan is where the business buys the deceased owner's interest from the heirs. Positives for this type of plan is there's only one policy on each owner, and it's purchased and owned by the company. The company is also the beneficiary. The company pays the premium. However, the premiums are not tax deductible. If permanent insurance is used, any cash value is shown as a corporate asset on the balance sheet. Negatives to a redemption plan would be that business control may shift at death. There is no increase in the survivor's owner's cost basis because each owner is not making an additional investment. Family attribution, which is a unique rule in family businesses for C Corps, could cause a redemption to be treated as a dividend rather than as a buyout. And finally, life insurance owned by a C corporation could potentially be subject to alternative minimum tax because it's treated as a preference item. The next slide will show that many times the most favorable plan design is a cross-purchase plan. With this plan, each owner agrees to buy the deceased owner's interest from the heirs. Positives to the cross-purchase plan include the surviving owners receive a step up in cost basis. And what that means is that they're actually making an additional investment in the business, and if they choose to sell the business in the future, this additional investment will reduce their capital gains. Any cash values in policies will be available to each individual policy owner, and control can be directed as desired. For example, let's say you have a father who starts a business, brings in a couple of partners. They may be sons or in either event minority interest owners, and let's say he retains 60% so that he's still the majority owner, and he gives each of the other two 20%. At his death under a redemption plan, each owner would then be 50% owners and have equal say. But what he may have found out that during the process over the years, one of the owners, additional owners or sons or daughters might be better suited to own the majority interest, and he can then adjust accordingly so that at his death, a minority or majority interest is owned by the appropriate partner. Things against a redemption plan or premiums have to be paid by the policy owner, and they are after tax. It is often when the corporation actually writes the check, but each owner has to claim that income as W-2 income. Multiple policies are required when there are more than two owners. If you have three owners, each of the three own policies on the other two, which means there are 6 policies. If you have 4 owners, each owns 3 policies on the, each owns 3 policies on the others, and you would have 12 policies. And as you add owners, you can see how that can be quite cumbersome. And finally, the difference in age can create quite a discrepancy. Imagine you have a 58-year-old owner and a 38-year-old owner. The price difference can be quite substantial. And the wait-and-see agreement on the next slide can be a combination of a redemption and a cross-purchase plan. This plan provides flexibility in determining the best plan of action at the time of death. In situations where the business grows in value, it may be determined that a cross-purchase be exercised up to the insurance amount, and the balance of the deceased interest may be redeemed by the corporation for the balance due the heirs. This approach is a little more complex, and it makes it a little more difficult to structure the life insurance along the way, but the attorney and the accountant can help to determine the best alternative. Finally, the last plan design, shown on the next slide, is the one-way agreement. This agreement is ideal for the sole proprietor, where a purchaser might be a key employee or an active family member. Where there's no obvious successor, an owner might opt to sell to a friendly competitor in the same industry. This may provide an opportunity for the purchaser also to expand their existing business. For an older owner that may wish to pass the business to a family member not in the business currently, they could use a one-way buyout plan if they can't afford to do so without compensation. So where do you start? On the next slide, you'll see a good place to begin is with your current clientele. And most of these clients will be either involved in or own a closely held business. I had personally had a case about 3 years into my career that I did a family plan, and at the end, when I asked for referrals, found out that his father was in business with his siblings, and he suggested I talk to his parents about estate planning. Well, having only been in the business 2 or 3 years, I didn't know a lot about estate planning, but I knew somebody that did. So we set up an appointment and went to talk to him about estate planning, but that led into a buy-sell discussion simply because we couldn't complete the estate planning without doing the buy-sell first, and it turned out to be the largest sale I ever made as a personal producer, simply by asking for a referral. Another good time to ask for is when you're completing a transaction or a policy review for other types of coverage. An effective door opener would be to ask, would you have any objections to reviewing your current life insurance with me? Common responses would be, that's a good idea, we've been meaning to do that. Another might be, we recently did that. They might say, we've already taken care of that, and your follow-up question might be, when did you last review your plans? They might have already taken care of it, but it might have been 5 or 10 years ago, and a review would certainly be in order. And then finally, we don't have any life insurance. And if that's the case, you might try the direct approach, which might be, what plans have you made for your business if your partner dies or becomes disabled? Another question you might ask is, what is your exit strategy at retirement? Many times the owner will not have a current exit strategy because they haven't considered retirement or may not even plan to retire. Any of the above will help you get the ball rolling, however, and most of you will see that a formal business succession plan is a good idea. That's my formal presentation. Brian or David, do you have any ideas or comments you'd like to add before we open up to questions?
Yeah, sure, Dave. This is Brian speaking here, and I actually know of a producer who uses that question. What's your exit strategy? How do you plan to get out of this business? And he does a lot of group health, but most of the life insurance business that he writes is with those business owners where he has the health account there. And what a great question to ask, because it can lead multiple directions, right? What's your exit strategy? What do you mean, what's my exit strategy? Well, how are you going to get out of this business? Are you going to run on this forever and ever until you die? And then you better have an exit strategy, because you passed away. Who's going to take over the business? But who's going to buy it from you? Because maybe you're 75 and you don't want to do this anymore. It just leads to all sorts of different directions, and really a great open-ended question to be asking folks there. I'm going to see if I can unmute some folks here, and so if anybody has some questions, give me just a couple of seconds here, and you should be able to hear everybody. It'll get a bit louder, and I think I'm going to go ahead and stop the recording at this point in time as well, so we don't have all that background noise here.